So, welcome to session 7 content. Today the focus is on valuation still, but where we are looking at is more specifically the market method, also called comparables. What you will see is that we will start with a brief review of what we have already seen about the income method, also discounted cash flow, and also with kind of an additional clarification on what it means to do the terminal value calculation. And then we will move into the core of the discussion today, that is the market method. So, what was important to remember on the valuation methods that we have available? So something important to remember is that not all methods approach the valuation from the same viewpoint. While we are looking at asset-based methods, it will be the whole idea that if I have to liquidate the company by blocks or by just whatever is available right now and I can just get some cash out of those assets, I would be following that approach. But if you follow the asset-based method, it means that let's say that the internal processes, the way that the company is run, has almost no value because the company is only worth the value of their assets. When we look at the income method, the whole focus shifts, and the only thing that we kind of pay attention is the ability of the company to generate free cash flows. This also means that we are kind of overlooking something, is that maybe those free cash flows have a different value depending on the moment. Maybe to be able to generate consistently $100 million of free cash flow every year with just a limited investment is something very unique in some moments in time, and it's also maybe something very common in other moments in time. So this is when the market method kicks in. Here the whole idea is that it's not enough to look at the assets, it's not enough to look at how much free cash flow we can generate and then try to have this rational approach to valuation of the discounted cash flow, but we also need to take into account the situation of the market. How is there right now, let's say, the market perceiving this type of companies? How is the whole uncertainty around the market situation and the future? This is what we try to capture with the market method. Last method that we will be discussing probably in another session will be the approximation of the option-based valuation. Just a quick recap. Asset-based method, remember that it was this whole focus on tangible and intangible assets. Income method, remember that it combines those elements. So it takes into account the value of future cash flows, then it looks at free cash flow, then it looks at how much should we pay to be able to generate those future cash. So the exchange, let's say, that we are having with our shareholders or other stakeholders, like maybe debt holders, that this is what is captured by the cost of capital. And then finally, we try to put this across time to be able to aggregate and have this present value of all these future cash flows. Just the key formulas that you need to remember is this whole idea that the value of money in time depends on which point are you making reference to. If you're looking at the lump sum of money in 20 years, you should know that when you bring it to the present value, there will be a change. The same way when you do the other way, or the way forward. No? If you have some money now, you're able to generate a regular outflow from that money, then this is something that will create more value. I don't want to spend time on this. You've been looking, otherwise you can always review the previous session on why it was important also to establish the terminal value. This is the idea that this method has a kind of a caveat, is that we need to introduce a final point in time where we stop trying to forecast and we just have this big, depends on the type of valuation you're doing, but this big weight on the terminal value. And to establish this terminal value can make our valuation shift quite a bit. So we need to be careful, or at least be aware of the impact it is having on the present value of the whole company. We discussed also different approaches on how to calculate this and some ratios. Here the story is that you can always double check. There are sometimes different approximations, small differences that it's good to be aware of those small differences and ways of calculating these final terminal values. The steps that I also would like that we remember is this: how do I approach it? I want to do a discounted cash flow, an income method application. How do I approach this whole process? So there are some steps that you need to. So first we start with the present day. We try to be able to determine as clearly as possible the free cash flow data. Once we are clear with the free cash flow data, we can start to project this in time. Then the whole big discussion point will be our discount rate, what we use, the weighted average cost of capital. And that's also a discussion because it will be fixed across time. It will not be changing every year. So we'll be using one number for the whole valuation. So it needs to be something that we are comfortable with. Then we move into the aggregated value of all those cash flows by bringing them to the present value. But what we get at that point, it will be the value of all those cash flows, but we need to take into account whether the company has a lot of cash, let's say our gold nuggets in somewhere in the company, but also if the company has already some commitments or a lot of debt, so that what we pay for it is something that makes sense. That's why we move from the enterprise value to the equity value of the company. So what is different about the market method? Well, we also like to call it comparables. As you can already get a feeling, this will be like a shortcut. This will be like a way of skipping some of these estimations and assumptions that come from the income method or the discounted cash flow. And here it will be taking the assumption that the market is efficient, that the market works well. What is the market right now paying for this type of companies? For a company that produces this type of cash flow in this type of industry with this type of assets, how many times the market is paying their present earnings? So this is the whole big assumption that is behind this, is the idea that markets are efficient so that they have information and that the prices that the market reflects is the proper valuation given the information we have. This comes from more the financial economics part, but this is the whole idea behind markets. So what do we need to do? We need to identify comparable companies, or what we also call peer companies. When it's a public company, there is a lot of available data, and this makes it easier to establish these comparisons. We can also have as comparable companies private companies, but we need them to have been involved in transactions. So, for example, a private company that has been sold, or that sold 20% of the company to another company, then we can use how much did that other company pay for them as a kind of our valuation model. So an idea, a similar transaction was valued at that price, therefore our company could be valued also at a similar price. This is usually complex, especially for very early stage companies. So usually it's a better method if you already have some sales track or things like this. However, it's a method that we can also add kind of a little trick. We can say, okay, maybe my company or my startup doesn't have yet any sales or any revenues. But when I have sales, when I get this maybe even break-even point, my company will be looking like this type of company or in this market. For example, if I'm in a software startup, I can argue that the numbers of my software startup, let's say it's also a SaaS model, no, will be very similar to an established player in this type of markets. Maybe for some time there will be differences, but the economics behind my business or my business model will be similar. Therefore, I can use these metrics that come from those established companies to argue that in 3 years, when I hit those revenues, my numbers or my valuation should be similar to those other valuations because of my growth rate, because of the type of costs I have, or the efficiency levers that I can pull, all those other elements. There is something that we still need to take into account, is that in any case, when we are doing these valuations and we are comparing our values to other companies, there is some penalties that we need to be aware of. So for example, the 20-30% penalty that we usually see on private companies when we look at their valuation, it's because of the liquidity aspects. So when we look at transactions, when we look at and we compare it to the market values of some similar companies that are public, we will see that there are some differences in the valuation. For example, how many times they pay for the sales of a supermarket that is privately owned and has been recently sold versus a supermarket chain that is trading in the stock market. So we will see a rich evaluation, usually for even if the operating metrics are quite similar, for that one that is in the stock market or it's public, because it's easier than to go in, go out, and it has value. Right? This is kind of later we can also discuss about this, but the idea that the investor has the option to pull out and still recover the investment, it makes it less risky. So the valuation is better. The whole exercise or the whole, let's say, artistic part in this method is to find the right comparable companies. How do I find these compatible companies, at least to a certain degree? There are two nice classifications. We could find clone companies and we could find guideline companies. Clone companies are exact replicas of what we are looking for. So companies that are very close in size, in revenues, similar cost structure, they operate in the same industry, they are equally diversified, like, I don't know, with services and products, or with also maybe they operate the maintenance, and they also have the sales and of the, let's say, the hardware or something like this. They make equivalent products and services, and also they have a similar capital structure. Doesn't need to be exactly the same, but the story here is that we cannot be comparing a company that has 80% debt and 20% equity with one that has 80% equity and only 20% debt. No, they need to be more or less structured in a similar way, 50-60, 50-70, all those things are okay. So what I would recommend now is that you pause the video and then you try to find, for example, a clone company for each of those that I'm mentioning here. The first one is Advanced Micro Devices, the following one is Diageo, and the next one is Pfizer. So you will need to understand what type of company they are, where are they operating, what type of products do they offer, and let's see if you can find a comparable company, in this case a clone company, so something that is almost exactly the same. You can pause the video and take these 10-15 minutes to complete this exercise. Welcome back. Now what we would like to do is that we will do something similar, but now for guideline companies. Guideline companies have several, but not all, the exact characteristics of the company. So what happens here that we need to combine, maybe it's a pharma company that also is exposed to some biotech business and maybe even has some diagnostics business unit. So we need to find whether it's something similar to Roche, or actually is more like Merck, or is more like AstraZeneca, depending, maybe someone has a business also in vaccines, while other ones is more focused on oncological care or applications. So we need to adjust a bit that valuation ratio, taking into account the weights of the business that they are exposed to. Another example could be, for the recent case, maybe if we want to compare IBM and Microsoft. The companies look alike and they operate in kind of let's say, a similar industry. But when we look at, for example, the weight of the cloud business in IBM versus in Microsoft is not the same at all. Or the weight of the professional services, the consulting activity, is not the same at both of them. So those type of elements, we need to weight them, take them into account. And that's when we have this, they have maybe, the case of IBM and Microsoft will be, they are in the same industry, but with slightly different businesses. But it can also be that they have a similar business, but in another industry. You can think about a distributor, no? A distributor maybe in sports goods categories versus a distributor in machinery. So you might say, oh, they look like their type of business is similar, however, they are working in a very different industry. This happens sometimes with some e-commerce platforms or similar situations. So we need to weight those things and be a bit more careful when we do this approach. Again, we try to do the same exercise. We try to look at Honeywell, we try to look at Rumble, and we try to look at United Technologies. Actually, now you will have to look at Raytheon Technologies because they've been recently merged. So it's Raytheon Technologies. And this is a very interesting case because now that they are merged, the business has changed a bit. So part of United Technologies is not anymore there. So then it's much more interesting to compare also with other pieces from United Technologies that are not there with the ones that are there, maybe, and then the Raytheon that brought a bit the defense business. how does it combine those elements, and how can I find a way to value companies like now Raytheon Technologies or Honeywell by looking at those guideline companies. Sorry, just to take a step back here, again, my recommendation now is that you stop the video and take those 10 minutes, 15 minutes to try to complete this exercise. We continue, welcome back. What we do now next is that the question would be, okay, I found companies that are either clone companies or guideline companies. What do I do next? So here, what do we do next? We look at, there are, at least I like those 3-4 ratios that I'm presenting here. So those ratios are good starting points. And what I need to do is I need to find the value of those ratios. So how much are people paying? The equity value, enterprise value versus revenue, enterprise value versus EBIT, or enterprise value with EBITDA. I need to find the values for the different clone companies, the different guideline companies after adjusting, or if I need to do some modifications in the weights or the elements that are behind the company. And then I have a benchmark. So what I need to do next is that I need to be able to use those ratios of how much is the market paying for net income, how much is the market paying for revenue, how much is the market paying for EBIT, or how much is the market paying for EBITDA. And then I need to kind of multiply, and I will be able to, using that ratio, how much should my company equity value or should my company enterprise value be? So what we do then is, like, as you can get the feeling, we are flipping a bit the approach. So I'm establishing the valuation of the company straight away just by looking at how much the market is paying for some of the traded available companies. The suggestion here is that you imagine that you have a company that sells sport clothes and you've been growing, and now your net income is 10 million euros or $10 million. So let's try now to work and find out which could be a guideline, a clone company, try to find the value for the different ratios. In this case, you only have information about the net income, so try to look at net income related ratios. So probably it will be a P ratio. So then what you would like then is to establish how much you should be paying for a company like this, how much should be basically the equity value of a company like this. Here again, it's a good moment to take 10-15 minutes and give a shot at this exercise. You can pause the video now. Welcome back. We continue. We could do now a similar exercise with a specific company. I mentioned here AeroVironment is kind of an interesting and complex at the same time company. And here what the suggestion is that you try to break down the different businesses that AeroVironment has, identify what is the weight of each of those businesses in the current revenues of AeroVironment, and then try to find what should be the metric for each of those different businesses. And then you can do this valuation by parts using the market method. So I repeat, the story here is when you have a complex situation of a business that is difficult to value, using the market method, you try to separate the different business units or different services that they are offering, establish what is the weight of each of those in their current revenues and their current, let's say, income. Assume that this is the way that this is moving forward. It's already an established company. And then you find similar companies and similar ratios for each of those businesses. So maybe if you have a service business and that generates XYZ number of revenues, how much you should be paying, how many times the net income, how many times revenues for that side of the business. The same for maybe the hardware or the maintenance service or something else. And then you would be putting this together, and then you would say, okay, the whole value of this company, after aggregating, taking into account the different weights of those different business units that the company is running, this will be the final value. Take time also to do this exercise. This is a bit more complex, but you can pause the video now. Finally, again, a possible exercise is that how do I work when I have all these comparables data, all these different elements? What I would like to do here is to be able to plot those things. I would like to that for each of those different metrics that I have, I'm able to show them in a graph, and I'm able then to show where does my company value stand between those different points of potential values based on comparable companies. So this would be, for example, something that you could give a shot again with the food and drink industry. Take a moment to also read the next steps of this possible exercise and try to plot those things together. How would you present this if you were in an internal meeting to justify the valuation of your company by looking at the metrics and comparables for those different possible ratios? What would be the result? And how would you argue that your valuation is correct? So finally, what was the objective of all this session? I'm sorry, and remember, a suggestion here is that you also take, again, 5-10 minutes to do all this exercise. This probably will require even more time to complete. But this will give you a very clear understanding on how those different metrics help you to justify the valuation of your project, startup, or even established organization. What was the objective of this session? The objective of this session is to first recap on the methods that we had seen, but very specifically to look at the market method. This is one of the easiest, more intuitive, and better, more efficient ways of doing a shortcut and being able to value something, even if you don't have all the data, but just by getting those key metrics and comparing it to other companies, other organizations that are out there. It's very important that you are very careful and you are knowledgeable when you select who are you comparing with, and that you do any of those adjustments that might be necessary in order to do a reasonable comparison. At the end, the message I want you to take away is that this is a very nice, quick method, and it becomes a very intuitive way also to then even check when you have a discounted cash flow valuation. Does it make sense? I can just do a quick validation with the market method. Does it make sense with what the market is paying right now? Yes, no. Thanks for today.